All right, let's talk about something that can seem a little intimidating: financial statements. They're often called the language of business, and for a good reason. But I promise, by the end of this, you're going to have the keys to understand what's really going on inside any company. So let's just dive right in.
And let's just kick things off with this bombshell from, Warren Buffett. 95%. Think about that for a second. That means the vast majority of people running businesses can't actually read the scorecard of their own business. It's a huge gap, for sure, but that also means it's a massive opportunity for anyone who's willing to learn.
So what's the big secret here? What do these other 5% know that everyone else doesn't? Well, it's not some crazy complex code. It's actually just knowing how to read 3 specific documents that, when you put them together, tell you the complete, unvarnished story of a business. And yeah, we're about to unlock that secret right now.
To really get this secret language, we have to start with one fundamental idea. It's kind of like the first rule you learn. It's all about understanding that there are 2 totally different ways of looking at a company's financial world.
Okay, so here's the deal. On one hand, you have the accrual basis. This is what most official financial statements use. It basically means you record a transaction the moment it happens, not when the cash actually changes hands. So you send out an invoice for a job you just finished, bam! Under accrual, that's revenue, even if you won't see a dime of that cash for another month. Then there's the cash basis, which is way simpler. It only cares about when money physically enters or leaves your bank account. And this difference, this is exactly why we need more than one statement to get the full picture.
All right, let's dive into our first key document, the balance sheet. If you think of financial statements as a story, the balance sheet is the once upon a time. It sets the scene and shows us where everything stands at the very beginning.
Probably the best way to think about it is as a financial selfie. It's a picture of a company's financial health on one specific day. Not what happened last week, not what might happen next week. It's just a snapshot that answers one simple question. If we froze everything in this exact moment, what is this company worth? And the heart of that selfie is this simple, perfect, unbreakable equation. Assets are everything the company owns: cash, inventory, buildings, you name it. Liabilities are everything it owes to other people, like bank loans. And equity is what's left over for the owners. So here's the key. Everything you own has to be paid for by either money you owe to others or money from the owners. It has to. Balance. Always.
And look at this, here it is in the real world. You can see the company's total assets add up to $1,967. And on the other side of the scale, its liabilities and equity also add up to, you guessed it, exactly $1,967. To the penny. It's not a coincidence, it's the law of the financial universe.
Okay, so if the balance sheet was a still photo, a snapshot, our next statement is the complete opposite. It's not about a single moment, it's about the story that happens over time. It's the movie.
Yep, we call it the movie for a reason. It's got a start date and an end date, just like a film. It tells the story of how a company did financially over a certain period, maybe a month, a quarter, or a whole year. And the entire point of this movie is to answer one single critical question. Did we actually make any money?
And you know what? The plot of this movie is super simple. You start with the top line, revenue. That's all the money you brought in from sales. Then you subtract all your expenses, the cost of doing business, like salaries, rent, everything. And what you're left with at the very bottom line, that's the grand finale, net income. In other words, the profit.
And when you see it with real numbers, it just clicks. Look, this company brought in $930 in revenue. They then paid out $485 in expenses. You do the math, and what's left? $435 in net income. It's a really simple, clear story about making a profit.
Okay, this is where things get really interesting. So a company can look great in its movie, right? It can look profitable on the income statement. But remember that pesky accrual accounting? Just because you earned money doesn't mean you actually have the cash. And a profitable company with zero cash in the bank can still go bankrupt. Which brings us to our final and maybe most important statement.
This one, the cash flow statement, is the ultimate reality check. It's like looking at your personal checking account summary. It doesn't care about promises or invoices. It only cares about one thing. Where did the cold hard cash actually come from, and where did it go? Because let's be real, you pay your bills with cash, not with profit.
And it neatly sorts all this cash movement into 3 simple buckets. First, you have operating activities. That's cash from your main day-to-day business. Then there's investing, cash you spent on big stuff, like buying a new building or new equipment. And finally, financing. This is cash from investors or from taking out loans. These 3 buckets tell you the story of every single dollar that moved.
So now we have our three documents, right? The snapshot, the movie, and the reality check. They might seem like three totally separate things, but they are beautifully connected. You ready for the magic trick?
Okay, so remember the end of our movie? That final number on the income statement? That net income, the profit we calculated?
Well, that exact number becomes the very first line on your cash flow statement. Bam! That's the bridge. That's the whole connection right there. You start with the profit on paper, and then the rest of the statement adjusts it to show you what your actual cash situation is. It's pretty brilliant.
So let's just recap the whole thing. Super simple. The balance sheet is a snapshot. It answers, what are we worth today? The income statement is the movie. It answers, were we profitable over this period? And the cash flow statement is the reality check, also a movie that answers, yeah, but where did the actual cash go? Three different views, answering three critical questions, giving you the full 3D picture of a company's health.
And there you have it. You're now officially in the 5% club. You have the secret decoder ring to read the language of business. So the only real question left is, now that you have this financial X-ray vision, when you look at a company, what are you going to look for first?